Hello and welcome to Applied Financial Planning's 2025 Mid-Year Outlook. I am joined here with our colleague, Sonu Varhese, who is the VP of Carson's Global Macro Strategist. Sonu, welcome. Thank you so much for joining us today.
No, thank you for having me. It's such a pleasure. It's always nice to see you and chat with you, Andrea.
I know it is a pleasure. I know. Hopefully, we'll bump into each other at some more conferences, or we got to get you. We got to get you out of that cold weather again.
Oh, I'd like to do that too.
Okay, good. Well, hopefully next time we'll see you in person. But thank you so much for your time today. For our clients, Sonu, in addition to leading the global macro strategy team, also works very closely with Carson and to lead the asset allocation team. And that we do very much consider those asset allocation weightings as it plays into kind of our house views on how we can best create your portfolio construction. So thrilled to be interviewing Sonu today. I'm going to hit you with all the tough questions that our clients hit us with. Very good. All right, well, we'll dig in. Before we get into the data, I did want to just share a few things with our clients. First and foremost, just as a reminder, today, the day we're recording, is actually August 7th, 2025. So by the time you guys see this information, it'll probably be a few weeks out, but we are talking about the data as of today, August 7th. I'm happy to be representing the full advisor team here at Applied Financial Planning. There's 7 of us. We've got William O'Connor, Sean Walker, myself, Andrea Graham, Marcelo Bernardo, Steve Henningsen, Jonathan Schaefer, and Spencer Johnston. So just as a reminder, you've got a really deep bench here at Applied Financial Planning to help you achieve your financial independence goals. Kind of the mid-year outlook kind of asserted it's just a little bit of a mixed bag. We still have kind of a healthy consumer. Some of the economic data that was coming out of Q1, that data that we had access to at the time we created this presentation a month ago, we still have healthy balance sheets. We in the team, we've been looking at some of these other reports that are coming out now with June, July, kind of some of the early August data, looking at like the latest PPI, which is a producer price index for our clients, which is measuring kind of the price of goods and services at a wholesale level. So that can be a leading indicator for us. So we've been looking at that in the manufacturing index, the jobs report for manufacturing. It does look like, we're losing some manufacturing jobs. What is this spelling out for the economy? Are things changing, even after what we saw in the Q1 data?
I'll say things are in flux. The big picture of the economy, and we were, in this business, you never want to be surprised, and you always, will be surprised. That's the only sure thing. But coming into this year, let's just rewind, right? 2023, 2024, the economy is growing around 3%. That was mostly being driven by consumption. Consumers are doing well. There's a lot of job growth. If you think about what drives consumption, it's income growth across the economy, across all workers in the economy. What's that powered by? You need more people finding jobs month after month after month. You need wage growth to be strong, and you need people working more hours generally, right? And that's what was powering income growth, and that's what was powering real GDP growth to close to 3% in 2023 and 2024. Coming into this year, we were optimistic, but we didn't think GDP would continue to run at a 3% pace, right? That was almost too hot, right?
Yeah.
I mean, which is not to say that was a bad thing. It was a good thing. We want more growth than less growth. But coming into this year, we
argue that the U.S. economy is now kind of it's mature enough to where that kind of slower 2%-ish growth is maybe more natural for
2 to 2.5% was thought, okay, that would be sort of normalish. Back to the 2010 trend, right? That was about 2.5%, 2010 through 2019 before the pandemic. And then obviously, coming into this year, you get into Liberation Day in April. All of that, the tariff hit, things like that. And since then, we've seen, a slowdown in place, right? And that's across the board. You mentioned manufacturing, right? Manufacturing survey data, like the Purchasing Managers Index, that tells you that there's less optimism on the manufacturing side. No surprise, given the tariffs and some inflation pressures on input raw material prices, things like that. You mentioned that's what the PPI captures, right? And manufacturing over the last 3 months, it's lost about 37,000 jobs. This is from, May, June, and July, right? Again, this is not a big surprise to us tracking the data. But at the same time, you have the unemployment rate still historically low at 4.2%. Because there's always a question, okay, we're in a slowdown, but does that lead to a recession?
Yeah.
At this point, we are not in the camp that this will lead to a recession. There is a
Okay.
slowdown in place, but that just brings economic growth to maybe 1.5% to 2%, as opposed to getting to zero. So
Right.
what's happening in the economy is that consumption is slowing as because income growth is slowing. There are some inflationary pressures because inflation is showing up in the price of raw materials, things like that, even core goods, furnishings, appliances, stuff like that, right? And electricity prices. We can talk about the AI story too,
Yeah.
right? Electricity prices are up about 7% year over year. That is a lot, right?
Yeah.
And everyone needs to keep the lights on. Not everyone needs to fill gas, right? That's a difference,
Yeah.
right?
That's a good point.
And so there is that pressure. But on the other side, you have that whole artificial intelligence story where there's a lot of capital expenditures being spent by these big mega cap tech companies, right? So that's sort of covering up for weaknesses in areas of the economy, including housing. Housing's weak as well, right? But you have a few things going on there. So that's the big picture.
Yeah, and I think we feel like whispers of it, right? Like you feel like where we're looking at the data, like that still it shows a healthy underlying economy, but then you start talking to, college grads, those job offers are slowing down. You start to hear whispers of
Yes.
people concerned about losing their jobs. As it relates to the AI trend, I just wonder if that's something we need to brace ourselves a lot for over the next 5 years. This understanding that I was reading a statistic. It said like 5 years from now, 35% of the jobs that people are working now aren't going to be there. So we're right in this midst of old jobs going away, new jobs coming online. There are going to be some painful pinch points along that process. So, um,
Right.
is
And
the
turnover is never easy, right?
no,
And hopefully, I think that's key what you said, the old jobs going away and new jobs replacing it, as opposed to mass unemployment. Because there is a fear that will AI just take care, just get rid of all the jobs. And that is not our view, right?
that would be
We are
great. I think
what you just
they
said.
said
We think
the
there'll be
same
new
thing
jobs.
about, didn't they say the same thing about like when the calculator was invented and when
Yes,
Excel was invented, as if we were going
exactly.
to like amazingly all of a sudden just, never need to learn how to do math again and never, we're going to be 1,000% more productive in our jobs. But here we
Yes.
are, even with calculators and Excel, still.
That's lovely. My kids are hopefully doing math in another room right now, but
Yeah, it's not going to go away. I think some of those fears of AI making everything kind of redundant, I think are for sure overblown. And I get why the tech CEOs are always touting this, new world with everything easy. That would be their dream. But
and that's a job, right?
yeah, that's their job to sell their company, sell that tech. Do you feel like when I look at and just a reminder to clients, we emailed out the full mid-year outlook with all the technical data back on July 14th. So that's in your email box. So I'm not walking through all the slides and that full presentation. There's a lot of data in there. We're really just focusing on kind of where are we at today? Have there been changes to this data even in the last month? Because now we're getting 70% of companies reporting their Q2 earnings. We can kind of revisit some of these numbers. Um, so I think when we look at as we are starting to get all the Q2 data and being able to process it, so I think things have softened, but not to the point that we feel like we're not out of kind of a healthy kind of slower growth mode. It's not that dramatic.
Right. Or recessionary,
Yeah.
if that's a fear. Yeah.
Do you feel like the one big beautiful bill that passed back in back in July is going to impact kind of any of these key indicators?
I think two sides to it. We were just talking about all the AI related spending. I think the one big beautiful bill sort of accelerates that or spurs a little more of that because what does it do? Big picture wise, yes, we got the tax cuts, on the individual level, things like that. But what really matters with respect to the economy, does it promote more investment?
Mm,
Right? Because ultimately that's what we want tax policy to do.
yeah.
If that, and I think it does that, at least in the short term, because
Okay.
it brings forward investment spending because companies can write that off and takes the tax deduction. So what do they have? They have more cash on their balance sheet, and they can use that cash for more investment, right? So you get a positive feedback loop there, and I think that's good for the economy.
I agree. I think some of those, it's not, I think it will have a net positive impact. Do you think that how do you think Powell's processing all of the latest data? Do you think he's making data-driven decisions right now?
They are in a fix, right?
Yeah.
I mean, they came into this year, policy was admittedly tight, and we are seeing the impact on that in housing. Housing activity is falling. And that's not great because housing is a critical part for how people form households, right?
And
People
that
get
shelter inflation, that housing number has been a big driver for inflation this year.
yes, and hopefully this year it's coming down. Now we've been in the camp that the Federal Reserve should have cut rates back in January and March
Yeah, we
because
agree.
we knew the tariff thing would come up. And tariffs, yes, it's a one-time increase in prices, but that's going to show up in the data in different kinds of ways. I mean, once that starts to show up, and it is starting to show up, core goods inflation is running at about 4% annualized pace outside of COVID. COVID is a special thing because supply chain
Yeah.
crisis. Outside of COVID, that is the fastest pace of core goods inflation since 1991. Now,
Mm,
we think this would be temporary because, tariffs are just a one-time increase in prices.
mhm.
But it's not optically, it's not easy for the Federal Reserve to cut rates when inflation is going the wrong way, further away from their target, right? Which is why we were in the camp that they should have cut rates before this instead of now having to wait. So
To
they have
juggle it
that. On the
back.
other side, employment growth is slowing, right? We
Mm,
just got the latest payroll report. There were big revisions in that, showing
mhm.
that over the last 3 months, the economy created 35,000 jobs on average. And most of that was healthcare jobs as well. So we are seeing that weakness. So they're stuck between, do we protect the labor market or do
Mhm.
we fight inflation?
Yeah, and I wonder, I kind of think, and I won't get into the weeds. I'm sure our clients aren't so interested in this, but I just wonder the Phillips curve, that relationship between jobs and inflation. I don't know that that has proven to be true over time. I would love to see the Fed maybe move away from looking at the Phillips curve or including that as they assess the inflationary impact that
Yeah, and right now, if they actually followed the Phillips curve, rates should be, much lower than they are, one could argue.
Mm,
And it is because of these certain supply-driven shifts. And we think from a strategic perspective, that's the world we are in now. We are not
yeah.
in the world of the 2010s when inflation was really low. And I would argue, I mean, everyone likes low inflation, but I would argue in some cases, we want a little bit of inflation because that means companies are raising prices, increasing margins, things like that. Right now, if there are supply related pressures,
Mhm.
inflation is going to be more volatile, right? And that's reflected in bond yields, things like that, right?
Yeah.
So,
It's really a little bit of a catch-22 though, because of the Federal Reserve. It's like well, before they were arguing that they weren't dropping the interest rates because shelter inflation was still such a large contributor. But the irony is like we can't really address the shelter inflation it's without more supply. We need
supply,
more
yeah,
housing, and then the builders can't build at these high interest rates. They can't afford to borrow the
exactly.
capital to finance the build. So we get in this kind of stuck in this loop of, well, we
Hmm.
need the lower interest rates to get the housing number,
Precisely.
problem solved, and it is a tricky. I found this cartoon I think you'll appreciate as we get into policy. It's the
Oh,
bullet
yeah, there we
bear
go.
just staring at Jerome Powell. What is he going to say next? Because it does feel like so much of how the next kind of how much of our outlook is really being driven by interest rates right now. We are all paying very kind of, it does seem like Powell has the power right now to take us one direction or the other.
No,
Uh,
absolutely. There is that. But at the same time, I think some of it tends to be, there's an over focus, if that's even a word or
mhm.
phrase, on interest rates. But the reality is companies are adaptable. And we've seen that actually despite the tariff thing, right? And that's a theme of, this last earnings cycle. It's adaptability,
Mhm.
right? Companies saw the big, huge, extreme tariffs in April. And a lot of them are actually prepared for the worst. Then
Yeah.
the worst didn't happen, but suddenly yes, this is part of the issue. They stopped hiring as much as they did in the prior months, last 2 years, and
Well,
they got
because
more efficient. And now they're starting to guide future profits higher than they did before Liberation Day.
Uh, well, and that gets into really, that's why we called this mid-year outlook uncharted waters, right? Because this idea of policy risk or having a president use their presidential powers to the degree that Trump is to try to shape the US economy and by default, shape some of the global economies because
And shape the global economy, really, how the global
yeah,
economy works.
it
And
really is. Yeah. But we've not had a president really since FDR do this. And so it does bring in this kind of policy risk to our portfolio decisions. And you see that with C-suite employees, CEOs, where they're like, we're not sure what our prices are going to be because we're waiting on the tariff resolution, things like that. So I think the tariffs have had an impact, at least to planning, and it's kind of slowing
Mhm.
things down as people wait to see what are their prices going to be. Can we afford to hire or not? Everybody's a little bit on pause. Um, do you think that there's a personal, do you think, I think it's interesting to me because Powell has, the chairman of the Federals, or Jerome Powell, has historically been really data driven. Do you think just because of the personal interactions between him and Trump, it's making him hard to focus on the data? Did you see that interaction with him of a couple
I
of weeks
did.
ago and the hard hats together? Oh, so awkward.
We should have worn hard hats for that
I know. Did they
in
need
solidarity to that moment, as opposed to either one of them, right? But no, look, I think Powell is experienced enough. This is not his first brush with President Trump, with President Trump.
Yeah.
President Trump was the one who appointed him,
Yeah.
right? And he was, the Fed chair through 2019, 2020, when uh, during President Trump's first term.
Yeah.
Right. So it's not like this is not his first brush with the president, and his comments and, all of that. Right. So I think they're still looking at the data. But part of it is the data is never clean and never points in one direction. And this
And then
is
now
part of
we're
the
dealing with a lot of data revisions, right?
yes. And so that is, I would argue that, yes, you want to follow the data, but at some point you want to also recognize that the data can lead you astray.
Mhm.
Right? And data can point in different decisions. And then you have to make a call of what I think is happening. What is my forecast for the economy?
Yeah.
Right. And you have to base policy decisions on that. And sometimes, admittedly, that can be wrong, but hopefully then you can pull back.
Well, that was one of my favorite quotes I read when I in my statistics classes, which is, you torture the numbers long enough, they're going to tell you what you want to hear.
Yes.
So there is a danger in just relying purely on, especially, the data. We need to use
Mm-hmm.
our own wisdom as we, and so from us, when we talk about the tariffs or the potential impact, I think that the tariffs haven't had as dramatic an impact on the economy as people thought. Um, do you think we're really do you think we're moving away from kind of that old-fashioned supply and demand kind of dictating where the market goes, or do you feel like this is like a new world where it's all about policy and
No, I think the policy are short-term drivers, have always
okay.
have been. And actually, ironically, probably really long-term drivers, like tax policy is an example
Yeah.
of a really long-term driver, right? It's just that in the medium term, it does get back to, supply and demand and profit growth, right? What's the
Yeah.
outlook for profit growth? Because if you pull up a chart of the market over, any long enough historical period, pull
Mhm.
up a chart on profits, kind of looks the same, right? The market's
Yeah.
driven by profit growth.
Well, let's talk about profits. I'll come back and talk about kind of expectations and stock market volatility. But while we're talking about profits, um, as of this moment in time, we've got about 70% of US companies reporting their Q2 earnings. Of that number, I was reading 75% of those reporting companies are all coming out with much higher earnings than what they told. So it does seem like, there's a lot of sandbagging going on.
And there always is. And there tends to be more sandbagging when things are,
Well,
very
uncertain.
uncharted, right?
Okay.
So back in April and May, it almost gave them an excuse to sandbag even more. And
Yeah.
then they go like, okay, now we've set a really low bar. And
Mhm.
by the way, the tariff policy also has been pulled back, right?
Yeah.
Even the tariff policies against China, I would argue that has been pulled back to such a huge, massive degree to the extent that it's been like tariffs on India seem more stringent than tariff policy against China for that matter, right? And a
Yeah.
few other countries like Brazil, even though China is it is the second largest economy in the world. So
Mhm.
tariff policy has been pulled back, but that's benefiting companies too.
Yeah. It is. So would you say there's a lot of talk about whether we're in a bubble? You hear it. Clients are asking us, are stocks overvalued? Are they fairly valued? Are we in a bubble?
It's
From
always
our
hard to,
perspective, it
yeah.
seems like I would argue that there certainly are sectors that are more expensive than another, but I would argue against that there's a stock market bubble per se, because like you said, the earnings, the profit margins are so strong. So there is, I think, a justification for these prices.
Mhm. And if you, like, my first thing is it's very hard to pinpoint a bubble, and especially when that bubble will end. If you predict that things, if you say things are in a bubble, then the next question, okay, when do you think it ends? And that's even harder to do, right?
Yeah.
A bubble is only, you can identify it only with the benefit of hindsight,
Hmm.
right? It's always the case. But what we can do is exactly to your point, look at, okay, where are stock market gains coming from? And right now, it's mostly on the back of profits. The S&P 500 is up about 9% year to date. We had talked, this is on August 7th, right?
Mhm.
Close to 60% of that gain is on the back of profits and dividends, right? Dividends are also profits that are returned to shareholders. Only, 40% or so of that gain is coming from multiple expansion, right? Which is when, everyone feels really optimistic about the future and are ready to pay a lot more for future earnings, right? That's what usually
Yeah.
gets people into trouble. You're not seeing that right now.
Okay, and my favorite way to explain to clients what that multiple expansion is, or when we talk about PE ratios, is I think my favorite
You said
analogy.
PE, I didn't say PE,
I
so
know you did a good job not saying PE. I said it, but I always think when we talk about multiple expansion, I think the best analogy is thinking of real estate, like price per square foot. So that makes a lot of
yeah,
sense to us that we are willing to pay more per square foot, let's say for a certain area or city than we are for, let's say, like Manhattan versus, the middle of Kansas on a farm. That's going to be
right.
different price per square foot. So that's what we're talking about on these companies based on that sector, based on the nature of that business. What is an appropriate kind of price per square foot to be paying for that? So people have argued this multiple expansion where that these companies have got expensive, but it's a tricky one to wrestle with when because you've got to forecast what you think is happening in these companies and that dynamism, which is a lot of the value that we're providing to the clients, because a lot of what we've talked about now, we've talked about kind of some of the systemic risk. There's unsystemic risk, and like, okay, do these companies have good managers, good cash flow, healthy debt structure, good business plans? There's there's some of that risk we can tease out by just, knowing the companies that we're investing in inside and out. But yeah, I mean, our opinion, we still in the portfolio feel like that the gains are still coming from the large names, and and tech is a big part of it. One of your slides I'm going to share here from the mid-year outlook. Kind of on your chart, you kind of had some of the U.S. companies and where growth-oriented companies are showing higher valuations. U.S. value, emerging markets, mid cap, U.S. small cap, international. So these are areas here where you guys feel like there's some opportunity, meaning they're trading at a lower multiple than they have historically traded at. Now,
Exactly. Yeah.
so what we're always looking for, okay, what are the indicators that would say it's time to move into these spaces, or that the environment is right for them to have some strong indicators? Because one thing we really rail against here, our investment committee does not like, is this idea of reversion to the mean, which is like eventually these stocks are going to come back to where they were before. Because I really feel like we need to be looking forward. Not, I think some of that data
Yes.
of how the stock market's done the last 50 to 100 years is no longer
Yeah.
appropriate.
And it gets back to that point about the bubble, right? I mean, it's hard to, first of all, pinpoint whether it is a bubble or not. And then it's hard to pinpoint when exactly it'll crash. So you kind of have to, I mean this in a good way, like ride the wave
Mhm.
of momentum. And
Mhm.
especially if it's coming on the back of investment and profits. Remember,
Mhm.
one person's spending or one business's spending is another business's income,
Mhm.
right? Yes, there's a lot of spending on the AI build out, data
Mhm.
centers, all of that servers, things like that. But that's also other companies' profits, and that's being reflected in the S&P 500. So
Mhm.
you do see large cap outperformance. That
Mhm.
is real,
Yeah.
right? And that gets to the fact that I am in the camp that I don't think this is a bubble, which is not to say that, we we could be in one by next year this time or 2 years from now, right? But it's
Yeah, well, like you said, uncharted waters. I mean,
yes,
we have what we call the known unknowns, right? We've been talking a lot
right.
about these known unknowns with clients, which is, we have planned responses, but we have to wait to see how these key pieces of data, what decisions are going to be made, what's actually happening. So yeah, these known unknowns, we'll just have to continue
Yes.
to watch closely. You mentioned, although the growth is coming from large, it's not necessarily meaning it would continue to do so. I did want to share a slide here with our clients about the volatility to expect in the market. So this is a great slide from our mid-year outlook that talked about when we look at the S&P 500 going back to 1928, what are typical pullbacks? So this chart is saying, look, there's going to be a 3% dip about 7 times a year.
Right.
We're going to have these things. Now that used to take like a week to do. Now it can happen in a day.
Yeah.
So that kind of whiplash happens. We've got about 3 times a year where we've pulled back at 5%, which we could call a mild correction. At least once a year, it's normal to have a 10% pullback. And then about once every other year, we would see a more dramatic pullback of 15 to 20%. So this is under normal conditions. So when you overlay things like a president like Trump, where we're dealing with tariffs, we're dealing with interest rates, and just coming out of still kind of in this post-pandemic environment, it's natural to expect a little bit more volatility. But certainly these are normal. So for our clients, we just always say, hang in there with us. Part of this is normal. So you're not going to see us in we're down 10%, make dramatic changes to the portfolio unless we think things have dramatically changed in the economy and that's warranted. Otherwise, some of this volatility is very normal and we'll just keep but I think the message for the clients is keep your seatbelts fastened because I think we're going to have a good end of the year, but it would be shocked if it wasn't bumpy. I think it'll be a bumpy ride with everything.
And to an extent, what that chart shows that it's always bumpy, but and this gets to the work you all do day in, day out, right? Much more so than me. Investment should be in service of the financial plan, right? And the investment itself can be bumpy, but you design the financial plan so that that's not bumpy.
Correct.
You account
That's
for that,
exactly.
right? And that's what you all do so well day in, day out.
So speaking of bumpiness and volatility, I'd be remiss if I didn't kind of pick your brain about crypto. So you've got a lot of shops, like let's say the JP Morgan analysts, people like that are saying, oh, look, clients should have 1% to 2% of their portfolio in crypto, kind of regardless, as just like so they don't miss the boat. That's a hard one for us to get on board with. But like we really like to see that the financials make sense and the underlying assets. So there's a lot of different ways to play kind of crypto or that AI momentum outside of investing in crypto. But do you personally feel that things like Bitcoin or Ethereum, XRP, that these should become, or is it a real asset class now that clients should have in their portfolio?
We think it's a diversifying asset class. Now, look, over the last several years, I mean, even 2 years back when everyone was saying there will be a recession, we weren't in that camp. We were one of the few shops saying there wouldn't be a recession. We were overweight equities. We're still overweight equities. And even from a strategic perspective, we like equities over bonds, right? So from that perspective, crypto is very volatile.
Yeah.
Right? It is a speculative asset, no question. And yes, you can stretch out for returns. And if you're an aggressive investor, maybe it's right for you. But this gets back to the work you all do again, right?
Yeah.
Like, what is the amount of risk you can take? And then there's a question of, okay, I want to put some more money into a aggressive speculative asset. And maybe there's place in the portfolio for that, but you have to replace it with something. And then, so because we've been very positive on equities, they're like, we'll just take that equity bet.
Yeah.
Right?
Now, doing just fine.
If that makes sense. So we don't want to add more risk to the portfolio because we're already overweight risk assets.
We're kind of in the same camp. I don't want to introduce when there is something so speculative, there's still a lot of unknowns. Obviously, the recent legislation does provide a lot more clarity that was needed in terms of like who the regulatory body is of these assets, things like that, when we're looking at the crypto space. But there's a lot of there are like you mentioned energy and how utility prices are really going up. Well, Bitcoin uses as much energy as an entire Department of Defense uses on an annual
Right.
basis. So I think that's an interesting place. So those would be, I think, a good example of a way that we could capture some of those positive gains or that momentum of
Mhm.
that trend without taking the speculation of the crypto, because utility companies are historically a lot less, risky
And you have
than.
to remember, like even when you're in, I think one thing, because uncharted waters, there's a lot of unknowns,
Mhm,
known unknowns, using your phrase. We love that framework of thinking of risk, right? Known
mhm.
knowns, known unknowns, and unknown unknowns. Most of the time, we can only worry about known unknowns,
Yeah.
right? To use Donald Rumsfeld's parlance, right, from back in
Yes.
the day. So, and when you have that, your best option is diversify it out. Now, when you invest in the something like the S&P 500, yes, there are different sectors, things like that, but you
Mhm,
are getting close to 45% exposure to technology and technology
mhm,
adjacent companies. That is
mhm.
the reality of it. And
Yeah.
then you have to ask yourself the question, and this may or may not be appropriate for you. That's the work you all do with your clients.
Mhm.
Uh, do I want to add more to that?
Yeah.
More tech exposure or crypto exposure, things like that. There is a lot,
Yep.
right? We're in the camp that, there's uncertainty, so diversify it out. There may
Yeah.
be pockets of the economy and even the global economy where you don't have enough exposure, and now may be the time to look for that.
Okay. Well, that's interesting thoughts. Well, before we wrapped up today, I do want to just pick your brain on the bond market. In our portfolios here for our clients, earlier in this year, we added some gold to the bond side of our portfolios. We also lengthened duration from those short-term bonds we were holding. We went a little bit longer into more of a kind of a core intermediate portfolio. Do you feel like these were good moves based on, if we're looking at a rate cut?
Yeah, no, look, my name is so my name originally in India. My name is I'm originally from there, but Sonu is derived from the Hindi word for gold, right?
Oh,
So you're asking
okay.
the wrong person about
Beautiful.
gold. No, I'm just kidding. No, we've liked gold for a couple of years now as a
Yeah.
diversifier.
Hmm.
Right? A couple of years ago, we didn't want to hold a lot of treasuries as a diversifier, but you do need a diversifier, something that hopefully zigs when stocks zag, and
Yeah.
gold was it. And we're still holding on to that gold position because we think, I mean, given going back to tying this back to something you said about President Trump wanting to remake the global economy,
Mhm.
in whatever shape or form, and I think they've stepped back from that a little bit.
Mhm.
But the other side of it is that the rest of the world may decide to diversify out of the dollar at the margin. I think the dollar is still going to be the reserve currency and all of that. But at the margin, there may be more demand for gold. So I think there is a place for gold in portfolios as a diversifier,
Mhm.
right? So I think that serves a purpose. And then bonds as well. I don't think it's the time to throw away bonds. You
Mhm.
need bonds. For example, if you're wrong about a recession,
Mhm.
right? What's the asset you want in your portfolio? Probably long duration bonds.
Yeah. Oh, good. Well, that is one of the things that we do pretty well here. We use in terms of diversifying the assets by the asset class, building the portfolio, but building it in a way that we're also getting that time diversification for the client. So as they're retired, we call it, we use the very fancy vernacular buckets of money.
Yeah, yeah. No,
I
it's
know
perfect.
advisors have come out with fancier names for it, but really having kind of insulating yourself so that you do have the time to let the stocks recover. We know there will be moments of time when they're down. So there are ways to hedge against that risk, and we definitely do that. All of the different areas that are available to you as a client. So we do have fantastic financial planning and retirement planning. So if you haven't taken advantage of that, I encourage you to talk to your advisor about that. We look at estate planning, the tax planning. So there's a lot of different areas that we can help you with in addition to just the investment management. So I would encourage everybody out there to make sure that you are taking advantage of all of the resources and the people here at the firm, because we are all committed to your success, and we're always doing our best for the clients. I think we could talk for another 30 minutes. I mean,
Yeah.
but we'll wrap up there. I think overall, at this moment in time, we're optimistic that we will continue to see growth in the economy. Um, and like we said, we'll just kind of keep watching those known unknowns and staying very nimble and adjusting as needed. But overall, things are, although I would say there's this backdrop of anxiety in America and in the world right now, there's a lot of stuff going on, but that civil unrest those civil issues don't often impact the portfolios. But what does very much impact the portfolios are things like the tariffs, the interest rates, tax law. So we're encouraged to see some of those more pro-growth policies kind of come through and hope that that translates nicely to the clients' portfolios. But yeah, we'll keep watching it like a hawk, and we appreciate having partners like you, Sonu, to just feed us tons of data, and we very much value your opinion. So thank you.
Absolutely. Pleasure to be here. Thank you.
Yeah. All right, good. Well, we'll see you again in a few months. We'll get our
Hopefully, yes.
2026
I love coming out to that area.
together. Yeah. But as always, just yeah, thank you for your time. Thank you to our clients for your time. We remain vigilant. We're ready. We've got planned responses for what could possibly happen in the market. So we've got portfolios on deck for challenging times, or if we see recessionary pressures, we've got those ideas ready to deploy. But at this moment in time, I think we're looking really good with our kind of the overweightings, underweightings in the sectors that we're focused on. So again, call us if you have any questions. Thank you, Sonu, and hope you have a great rest of the summer with your children. You getting ready, and everybody gets back to the new school year safe and sound and enjoying it. So
Thank you. You too.